Well, first off, a year ago, the real worry was that the tariff story would be terrible, that there's, the far right-hand side of the curve with 80%, 100% tariff rates really would impact pricing tremendously. But over time, of course, we've seen that increase in tariffs really narrow, become much more moderate, 10 to maybe 20%. So, and subsequently, a bunch of that has been not passed through from the service companies to operators. So generally speaking, inflation in the oil patch has been pretty moderate. We think that'll continue to be the case this year. But point being that any lower well costs that might be realized on the part of operators is likely to come not so much from beating suppliers down in terms of what their unit costs are, but really through design changes, continued efficiency gains, maybe some changes in your supply chains. Things like that will, I think, be more important to where costs to drill and complete will go. It's interesting when they do surveys among operators now. I think on average, somewhere around 50 to 60% of the firm's operators talk about trying to make some use of artificial intelligence in their operations, where that might be applied. Is it on the production side to optimize your gas injection rates on gas lift operations? Is it in terms of analyzing seismic data? Is it geophysically focused, that kind of thing? But when you then say, well, what kind of a cost per barrel impact might those artificial intelligence, applications realize for you? It's pretty modest. They're talking about maybe a $1 or $2 improvement in break-even costs because you're using AI. So we're clearly in a world where we need to find every option we can in terms of improving break-evens. But at least at this point, the AI is not overwhelming the story in terms of getting lowering break-even costs. But that brings me to my next slide, which is one that's about, hopefully the next slide. Yeah, there we go. I talk about break-even costs a slightly different way. Most of the time, we hear break-evens. What does that well out in Cherokee Play need to realize in terms of break-even costs? This particular chart you're looking at is one that thinks about break-evens from the standpoint of an investor in an oil or gas company. So what we've done is we've taken data from 2015 to 2025. We've looked at what the return on invested capital, so that's what ROIC stands for, return on invested capital, and matched up for this group of U.S.-centric E&P companies, what kind of return on the capital have they been able to enjoy over the years on average, and match that up against what was the price of oil during those years, right? So you can drive a nice little scattergram and then draw a curve through it. And anytime you get an R-squared ratio that's in the 0.87 rate, you've really nailed it from the standpoint of being able to find some explanation, which intrinsically makes sense, right? The higher prices go, the better the profitability of the industry is, the better our returns. Lower prices, just the opposite story. The thing that keep in mind then, when you look at this chart, is if you're an investor in the stock of an E&P company or a private equity group thinking about taking somebody private, the question is, what's my target return as an investor when I'm thinking about the E&P space? And most of the time, that number will fluctuate a little bit, but most of the time it stays in the 10 to 12% range. So you can look over on the left-hand side, the y-axis, and say, where's 10 to 12%? Run it across, where does that intersect the line? And what that says is, on average, the industry needs about a $65 price in order to realize the target return that an investor has for an operator. And then the question that we have to solve as an industry is, how can we realize a double-digit rate of return if oil prices are going to be $60? Or what's the cyclical low? Maybe $50 price, right? So that's really the test as an industry we have to meet, is can we get to what does it take from an operational standpoint, from a well-designed standpoint, from an acreage standpoint, from a business consolidation standpoint. All those factors begin to play into this notion of how can we lift the curve so that at a $60 price or a $65 price, we're realizing the kind of returns that operators want. It's easy enough when the market takes us to a $90 price. We'll make everybody happy in those circumstances. The real test is what needs to be done, what actions do companies then consider and take in order to lift the curve and get to that target return on capital level at a low oil price. And so I think that's something to keep in mind, and I think we'll certainly explain the actions that have been taken the last several years, the actions that we think will continue to be taken in 2026 and 2027 going forward. So, the easy levers, the ones that people instinctively reach for first, have reached for, is scale, right? So consolidate operations, company A by company B. You're now larger, you've got economies of scale, you can begin to improve your returns in that fashion. That's been done. I think that'll continue to be done as operators look to optimize their portfolios and attempt to again, realize returns that their investors want to see. The other thing too then is the consolidation approach. By advancing contiguous acreage, now we can go to a 4-mile lateral, right? So that's the other part of the story that has been front and foremost in terms of what companies are doing in terms of trying to lower break-even costs, right? So, again, a lot of beneficial aspects when you go 4 miles. These days, by our lights, the industry here in the U.S., we see about 5% of the wells that have 20,000-foot laterals. So the number is growing, and we expect it to grow further, but that's where we are today. But I think that's the other thing besides consolidating businesses is what can you do operationally that has an effect in terms of lowering break-even points for individual well costs. And so it then has some other beneficial effects that are nice: protection of the environment, efficient use of capital, and so forth. So this is the kind of thing that I think will continue to explain why we see increasing take-up from the standpoint of longer laterals, right? So then just some numbers to talk about sort of the macro supply-demand pictures as we see things on the oil and gas side. So global oil on the left-hand side looks at changes in global oil consumption year over year from 2024 to 2028. It goes up and down, but generally been fairly stable around 1 million barrel a day growth year over year, roughly 1%, as it were, growth rates. And the important thing to keep in mind when you look at the chart on the left is where does that growth coming from? Because we hear a lot of news about economic activity here in the U.S., a lot of news about China, a certain amount of news about Europe, and nothing when it comes to what's happening economically in Africa and South America, places like the Middle East or Central Asia, but yet it's those emerging markets that account for something like 75% of the growth in global oil consumption year over year over year. That's been a very steady aspect of global consumption. So a lot of worries and headlines about, things are slowing down here, they're slowing down in China and whatnot. But the fact of the matter is that collectively, China, US, and Europe are only about 25% of the annual change year over year. So our headlines shed a lot of heat, but not a lot of light on the discussion about where is consumption growing. So we're pretty comfortable with the notion that 1 million barrel a day growth rates are probably with us for a while longer. We're not nearly at a peak oil kind of a number when most of the growth is happening in emerging markets where the average consumption of oil is somewhere around 3 barrels per person per year, whereas it's 14 or 15 barrels per person per year here in the US. So they've got a long ways to go to catch up with us. The question then becomes what's happening on the supply side, and that's the other chart, right? So clearly last year with OPEC opening up its taps, with a fair amount of new production coming on stream from countries in South America, Brazil, Guyana, and so forth, we have had a net change of a little over 2.5 million barrels a day in terms on the supply side. So yeah, we're oversupplied, and there's that's why there's been the softness in the market. That's why oil prices that were averaged $75 a barrel in 2024 averaged $65 a barrel last year and on their way to $60 a barrel this year. So market's oversupplied, but again, as you look at the chart on the right-hand side, what you see is that the net growth in supply is diminishing. This year, something maybe on the order of 1.5 million barrels a day in supply growth, again, against a market that's demand's grown 1 million barrels a day. So the out of balance numbers are shrinking, and then by the time we think we get into 2027 and 2028, then we'll be roughly in balance, roughly 1 million barrels a day growth on either side, whether you're talking supply or demand. So oversupplied at the moment, soft, but improving. And so as a result, when we think about where prices might go, and again, on the left-hand side, WTI, $60 a barrel is our guess at the average price this year. We think then it'll begin to recover over the next couple of years, not certainly not return even to the glory days of 2024, but improving, we think. The real story in terms of commodity prices on the gas side, we all kind of recognize that. Last year, we saw an average gas price around $3.50 per million BTUs. The year before, it had been $2.10, I think. So we saw about a 60% increase year over year in terms of spot gas prices down at the Henry Hub. Next year, or I should say 2026, we're thinking it's a $4 price on average at Henry Hub. So we go from $3.50 to $4 from 2025 to 2026. So the gas story is certainly one of a stronger market that is, and prices rising because we're a bit undersupplied there. So, and certainly the winter weather that we had recently has helped in that regard, right? So a strong winter, cold winter, adds about 5% to gas consumption here in the U.S. If you look at the whole year as a whole, a warm winter takes away about 5% in terms of gas consumption. So there's quite the swing there. And so I hope the signs augur that we'll be stay on the cold side and that inventories will remain pretty tight. So I don't think I turned anything off, Scott, but if I did, here we go. Here we go. So gas consumption. So here in the U.S., we produce almost 110 BCF a day. 90 BCF a day, about 80% of what we produce is consumed here in the U.S. We export about 20% of what we produce. So the story on the gas consumption side, domestic gas consumption, is that there's slow but steady growth overall there. You can see 90 BCF a day. We're looking at 1, maybe 2% in aggregate. But the real growth story is, as we know, over on the power generation side. All these data centers have been announced, and many of them will rely on natural gas for power that they need, right? And so when you add up all the hundreds of data centers announcements that have been made, and then you sort the list for which ones are going to have natural gas, supplying power, and then add up what that means in terms of incremental growth for natural gas, you end up with about 15 BCF a day in terms of incremental demand growth for natural gas consumed in the U.S., just from the power generation side, just from AI. So we're at 90, 15 BCF a day delta is almost 20% of the market. And my guess is that we won't see that whole 15 BCF a day realized. There's local pushback, as we begun to hear. There's the whole issue of getting the equipment, the gas turbines, the pipelines, everything built and in place. And so I'm sure that 15 BCF a day number is a little bit optimistic. Perhaps more realistically, we can think that AI will mean a 10 BCF a day growth in domestic gas consumption, which is still a pretty healthy number, right? Over the next 5 years, we might go from 90 to 100 BCF in terms of domestic gas consumption. So good story there. And then, of course, that's matched with what we see happening on the export side. So exports this past year, both pipeline and by LNG, added up to just around 23 or 24 BCF a day. So, and the LNG side is growing at about a 10% clip year over year, this we think. So again, when you think about the LNG terminals that are being built, right? We've got roughly another 10 BCF a day of LNG terminals that are to be constructed over the next 5 years or so. And the hope is that those will all then become fully utilized, and we'll see another 10 BCF of gas export growth over the same kind of 5-year time span. So 10 BCF a day growth in terms of domestic gas consumption, 10 BCF a day growth in terms of export capacity. That's a pretty substantial delta from a gas production standpoint over a 5-year time frame, 5, maybe 6-year time frame. So that's the kind of macro picture that gas producers here in the U.S. are, I think, are embracing, and will need to plan around in terms of what we can do about making sure that we've got the supply that's necessary in order to see all that happen. So that's my final slide here, and then I'll be happy to answer any questions. So natural gas production, if you're only looking at it for the next 2-3 years, looks a little bit underwhelming, but a steady 1 to 2% growth rate we think is in the cards. The bigger supply story on the supply side is, where's that growth coming from? So Marcellus is in blue, the largest single area for gas. Much of that gas is going to stay domestic and end up supplying the data center market. The Permian will be is our next biggest area and growing at a pretty substantial clip. Although within the Permian, we've got gas production falling on the Midland side and rising on the Delaware side. So I understand you have a speaker coming to talk about what's going on in terms of Delaware basin activity. Should be very interesting because those in that part of the world, I think 5+% growth rates are entirely realizable based on what we think is the case for the outlook for drilling activity. So with that, I will take any questions that folks might have on either matters I've spoken about or on things that I haven't addressed but are near and dear to my heart. So the outlook for St. Louis Cardinal baseball would be right up there if anybody's got that in mind. So don't be shy, and I understand there's a microphone somewhere around there if anybody has anything to ask. So I might just say in the meantime that the AI story is a fascinating one. A lot of companies have high hopes for it. A relatively smaller number are making use of it, and when you think about who gets to sort of go first or who's best positioned to take advantage of it, the world that we work in these days with unconventional shale and large shale majors there, right? So they have quite the data set. In the old days like when I started, but way back when, most of the time it was service firms who had the broadest data set. They worked for a lot of different operators doing a lot of different kinds of drilling and completion. And any individual operator in that county might only have a handful of wells that he drilled. So he really relied upon the service firms to really bring to them and say, here's what's going on, here's what you should do and whatnot. Now we have the powers on the other side of the table because we have so many big operators who drill hundreds of lookalike wells. And so they've got the data set that they can turn their algorithms loose on and try and identify, well, what can we do a little bit better that would realize a 3 or 5% uplift in terms of profitability? And we can apply that to the next 200 wells we're going to drill. And so the operators have, because they have that data, they're in a very strong position when it comes to being the ones to really drive that embrace of artificial intelligence in the oil patch. So that's what I'm anxious to hear and talk to operators when I have a chance to chat with them about what they're doing, both on the drilling side, the completion side, and the production side. So, yes, sir.
As you know, we've got a debate. Follow the course of the regular station. I have a couple of questions. The one where you are kind of expecting like $60 a barrel for the following. Are you considering there the incremental production on the completions and Michelle and soil to the rate of initial
Yeah. So both of those, incremental output from either of those places, Venezuela or Iran, is hard to guess right now, right? I was at a meeting last week down in Houston where chief economists of both ConocoPhillips and Exxon were addressing and had that question asked to them. And in both cases, they said, what's happened to date anyway that we know about really hasn't restructured either how much we're spending, what our capital budgets look like, or the order in which we're prioritizing things. Iran, Venezuela especially, is still pretty low down the list because there's so many above ground issues that need to be resolved. What's the tax take going to look like? What kind of fiscal and regulatory reforms need to be? So everybody knows that they've got a lot of potential when you just look at the below ground issues, but the above ground stuff is going to keep much of a development effort until several years down the road. In the meantime, I think, particularly with Venezuela, we'll see operators lift as much oil and buy it and run it through refineries in the Gulf Coast as we can. But I don't think we're going to see much of investment on the upstream side in that country anytime soon. So.
And another question, obviously, I'm also second that this is actually in the commercial side and the also opportunity the required for prepared in terms of budget. But the other question is, I saw the graph regarding the return on invested capital versus the price of oil.
Mhm.
And you make the case that yes, it's possible for consolidation because of the competitors and acreage you can grow water holes and economics is better. But is there a point in your modeling where there's a breaking point or inflection point of how large those companies emerge? Because the way I think about this is you see the cycle. Companies start consolidating, eventually become larger and larger, and it becomes so large that then the operating expense you have to add a lot in your management. And because the fence eventually goes to private equity. Is there any, do you see like based on this price, it's dollars, this is the most optimal size for any.
It's a wonderful question to ask, right? Yeah, no, and I think at that point, there does become a point where the bigger companies will look around and think about, and I think about, from their perspective, I think the discussion around do we get even bigger domestically has to take into account what kind of international opportunities might we have and how do they compare in terms of ROI versus getting bigger domestically and buying that company or buying this acreage over here and doing that. So I think at some point, I think the story over the next 5 and 10 years will be, and I guess you've had a speaker or two talk about it, that some of these companies will that have been so U.S. focused will now begin to look abroad as a way of because there'll be opportunities elsewhere. The challenge in doing that is that they have to negotiate the tax take that the host government has. Most international projects, the host government ends up with about 70% of the revenue from the sale of oil or gas, and so there's the tax take issue is much higher overseas, meaning that the break-even point has to be much lower. You might have to have, if an average break-even point here in the U.S. for a well was in the 50s, it'd probably be half that or something like that for an international project, just simply because the government's going to take a much larger share of the money. So that's the challenge that these oil companies, as they grow bigger, will have to embrace. Is like, how does getting bigger in the U.S. compare with beginning to move abroad and maybe diversify our risk in that fashion? Yeah. If there are any hands up in the back of the room, I can't see them. My eyesight's not that good. But thank you very much for having me here today, and welcome. Hopefully I have a chance to come back. So thank you.